Hi students, it's Carly again, and this is the second video of financial statement analysis. If you haven't watched the first video, I would strongly encourage you to go back and watch the first video before you watch this video. In the first video, we looked at the objectives of financial statement analysis. We also looked at the limitations of accounting information. We then looked at the various approaches to financial statement analysis. In this video, we are going to interpret commonly used financial ratios. We will revise the DuPont analysis and also have a look at failure prediction models. Then lastly, we'll look at the limitations of ratio analysis. So the first group of ratios I want to have a look at are liquidity ratios. So liquidity ratios are analyzed as we want to ensure that the firm is able to meet its maturing financial obligations. The two best measures of liquidity are the current ratio and the quick ratio. If we look at the current ratio, we can see that it is made up of our current assets divided by our current liabilities. Our current assets are things like our accounts receivables, our cash and cash equivalents, and our inventory. Our current liabilities would comprise things like our accounts payable, accrued expenses, and other short-term borrowings like a bank overdraft. The current ratio indicates the extent to which the claims of short-term creditors are covered by short-term assets. Now, in high school, you would have learned that a good current ratio is 2:1. However, I want to challenge that as this is not normal depending on the industry. So I never want to see in a question that the current ratio is good as it is 2:1. That is incorrect, and you will not get any marks for that, and you will just annoy the marker. When you are looking at this ratio, in order to assess where the liquidity is improved or deteriorated, you need to compare this ratio to other companies in the same industry to assess how our company's liquidity is. Also, if you look at different industries will have different norms for the liquidity ratios. If we are dealing with supermarkets and supermarkets sell perishable items that go off quickly, they will not have a lot of inventory on hand. Also, people usually pay cash when they buy groceries and do not buy groceries like bread and milk on credit. So they will also have a very low debtors balance. So if we look at this, for a grocery company, they may actually have a very low current ratio, but this could be very normal for the industry in which they operate. So it is very important when you are commenting on these ratios to not just go by rules of thumbs. Rules of thumbs are actually meaningless. We need to look at the industry in which the company is operating, and we also need to look at other companies in the industry to compare how our company is doing. So another ratio that gives an indication of liquidity is the quick ratio. This ratio is calculated by taking our current assets, excluding our inventory, and dividing that by our current liabilities. As it normally takes longer to sell inventory and turn it into cash, it is useful to measure the firm's ability to pay off our short-term obligations without relying on the sale of inventory. If a company wants to improve its liquidity, there are various things they can do. If they want to improve liquidity in the short term, they can renegotiate payments to providers of debt. A company could also delay capital expenditure or delay the payments of capital expenditure. If a company wants to improve its liquidity in the short term, it could also delay declaring and paying a dividend. They could also delay paying tax liabilities, but there could be penalties and interests for this. If a company wants to improve its liquidity permanently in the long term, there are various things that it can do to achieve this. It could issue new shares. It could also reduce its inventory levels. It may do this by implementing a just-in-time inventory system. It could also calculate economic order quantity if it decides to implement a just-in-time inventory system. Another way to reduce inventory levels is to improve the turnover of inventory, and this would be done by increasing sales. The next group of ratios we are going to look at are the asset management ratios. These ratios measure how effectively management is utilizing the company's assets. The first ratio we are going to look at is the inventory turnover ratio. This is calculated by taking the cost of sales per annum divided by the average inventory. If you look at the name of this ratio, it indicates that turnover should be used. However, if we think about inventory is recorded at cost price, where sales is recorded at the selling price. So it is more meaningful to calculate this ratio by using cost of sales as opposed to turnover. So in a question, if they give you both sales and cost of sales, you must use cost of sales. However, if cost of sales is not given to you in a question, then you will have to use turnover. You will see that in the formula, it says we are going to divide cost of sales by average inventory. As most inventory is seasonal, it is more meaningful to use an average inventory level as opposed to year-end level, which is at a point in time. For the sake of comparability, if you are calculating ratios and comparing the ratios to another company's ratios or to industry ratios, what you'll have to take into account is for your comparison to be useful, in the same way, you need to calculate your ratios in a similar way to which the industry has calculated their ratios. So if you can see that the industry you are comparing your ratios to has used turnover or has used inventory at year end at a point in time, then in order for your comparison to be valid, you will need to calculate your ratio in a similar way. However, cost of sales divided by average inventory is the preferred method and gives a more meaningful analysis. The day sales in inventory is calculated in a similar way. We are going to take average inventory and divide it by our daily cost of sales. Then we have our working capital turnover ratio. This measures how well a company is utilizing its working capital to support a given level of sales. So a high ratio indicates management is being very efficient. This ratio is calculated by taking sales per annum divided by our net working capital. And remember, our net working capital is our current assets less our current liabilities. If we look at our accounts receivable collection days ratio, this is calculated by taking our accounts receivable balance divided by our daily credit sales. Why are we using credit sales and not total sales? Sales can be made for cash and on credit. As we are looking at our accounts receivable days here, it is appropriate to use our credit sales and not include any cash sales, as this would skew our analysis. This ratio shows the average length of time that a firm must wait after making a sale before they receive the cash from the customer. If we look at our fixed asset turnover ratio and our asset turnover ratio, these ratios indicate the utilization of these assets. So if we look at our fixed asset turnover ratio, this ratio indicates the utilization of PPE relative to the operating levels as reflected by sales. So this ratio is calculated by taking sales per annum divided by our fixed assets. Then we have our asset turnover ratio. This is calculated by taking our sales per annum divided by our operating assets. So when we say operating assets, this does not include any investments. So a company can have investing activities and they can have operating activities. As we are assessing the efficiency of management's utilization of operating assets, we will make sure we do not include any investment assets, as these are not part of the operating assets. The asset turnover ratio measures the utilization of all firms' operating assets in relation to sales revenue. Then we also need to consider things like our operating cycle and our cash cycle. How do you calculate these cycles? Well, our operating cycle is calculated by taking your inventory days plus our accounts receivable days. This cycle indicates the number of days a company takes in converting its inventories to cash. It gives the time taken in selling inventories plus the time taken in recovering cash from trade receivables. Then how do we calculate the cash cycle? The cash cycle is simply calculated by taking your operating cycle minus your accounts payable days. The length of the company's cycles gives an indication of the company's liquidity and also an indication of its asset utilization. The next group of ratios we are going to look at are the debt ratios. Now, debt plays an important part in financial management. Often a company will need to raise capital, and it can either do that through issuing shares or it can obtain an interest-bearing long-term loan. One of the disadvantages of issuing shares is that it dilutes control for the current shareholders. So a company may sometimes want to raise capital by way of long-term interest-bearing debt. As the company increases its long-term interest-bearing debt, the financial risk of the company will increase. There is something called financial leverage. As the company increases its long-term interest-bearing debt, it is said to have more financial leverage, and the more financial leverage a company has will increase its financial risk. This increase in financial risk occurs because the debt finance incurs interest payments. These interest payments are fixed. Therefore, regardless of the earnings of a company, these interest payments have to be met. However, the additional financial risk can actually yield an additional return if the company earns more on the borrowed funds than it pays in interest. When we are looking at our debt management ratios, one thing I want to point out is that when we have deferred tax liabilities, these are often going to be treated as equity when we perform the ratios. So if we look at our debt to equity ratio and we want to determine this ratio, we need to look at our deferred tax balance. Often this will be recorded as a liability in your statement of financial position. But we have to ask ourselves, if this deferred tax balance is not going to be paid, then should it really be recorded as a liability? Because a liability shows an obligation that is going to be paid. Because we know in the future there are going to be future deferred tax assets raised, which will reduce the deferred tax liability, it is unlikely that this deferred tax liability will ever actually be paid. So if there is no intention to pay this deferred tax liability, when we are calculating our ratio, we are not going to include this as part of debt, but we are going to include it as part of equity. However, if there is an intention for the company to pay this deferred tax liability, then yes, we can include it as part of our debt. Another thing we need to consider is when we have overdraft facilities, these could be shown under our current liabilities as they are considered short-term loans and will need to be repaid within 12 months. However, if a company has an overdraft facility consistently year on year, then in actual fact, when we are doing our ratios, we should include this as part of the long-term debt, because even though it is included under current liability in the statement of financial position, it is used consistently year after year. Therefore, it should actually form part of the permanent debt structure when we are looking at our ratios. So if we look at our debt ratio, this is calculated by taking our total debt divided by our total assets. The debt ratio measures the percentage of total funds provided by creditors. So the higher the debt ratio, the higher the financial risk. And while a very high ratio would be unattractive because of the high level of risk, a very low debt ratio would also be unattractive because of the returns that could be leveraged, which have been foregone. So the debt-equity ratio is similar to the debt ratio, except the debt-equity ratio measures the ratio of interest-bearing debt to total equity. So this ratio indicates the extent that interest-bearing debt is covered by shareholders' funds. Then if we go to our debt to market capitalization ratio, this ratio is calculated by taking our total debt divided by our market capitalization. How do we calculate our market capitalization? This can be calculated by taking the number of ordinary shares issued multiplied by the market price per share. So the market capitalization ratio, this ratio gives the investor a way to measure debt against the firm's ability to raise capital. Then we can move on to our coverage ratios. If we look at the first one, being the interest cover ratio, this is calculated by taking your earnings before interest and tax, also referred to as EBIT, divided by your interest cost. So the interest coverage ratio determines the extent to which earnings can decline without causing financial loss to the company. If we look at our interest cover ratio, you can see that we have calculated it by using earnings before interest and tax. Included in these earnings would be non-cash flow items like depreciation and amortization. So sometimes a company will want to calculate an EBITDA coverage ratio. This is your earnings before interest and tax, depreciation, and amortization. Then we also have a fixed charge ratio. This ratio is calculated by taking your EBITDA, which is your earnings before interest and tax, depreciation, and amortization, divided by your interest costs and lease payments. As the way we account for leases is changing due to IFRS 16, which comes into effect on the 1st of January 2019, all leases are going to be treated as finance leases, which means that there won't be lease payments anymore. So this ratio may not be calculated too much going forward. Then we have our last debt ratio being our cash flow to total debt ratio. This ratio shows the company's cash flow from operations to its total debt. So this ratio is a type of coverage ratio that can be used to determine how long it would take a company to repay its debt if it devoted all of its cash flow to debt repayment. The next group of ratios we are going to look at are profitability ratios. So the profitability ratios will reflect the combined effect of liquidity, asset management, and debt management. Our gross profit margin ratio is calculated by taking our gross profit divided by our total sales times 100. Then we have our net operating profit margin, which is calculated by taking our earnings before interest and tax divided by our total sales times 100. Then we have our net profit margin, which is calculated by taking our net profit divided by our total sales. When we look at our return on assets ratio, which is also commonly referred to as ROI, here there are different ways we can calculate it. So we can calculate it by taking our earnings before interest and tax divided by our total operating assets, or we can calculate it by taking our earnings before interest after tax divided by our total operating assets. Earnings before interest after tax is also known as net operating profit after tax. Then the last way we can calculate it is by taking our net profit divided by our total assets. So deciding which definition of earnings should be used, this will depend on the objectives of the analysis. If we are using earnings before interest and tax, this is useful when comparing companies who are in different countries and have different tax jurisdictions. It is also useful in assessing companies which have different degrees of financial leverage. As you are using EBIT, it is your earnings before interest. So your analysis will not be skewed by companies who have different levels of long-term debt with different interest expense on that. So using your net operating profit after tax or your earnings before interest after tax, this is conceptually the most correct approach. And the reason for this is that it excludes interest, which is a cost of financing, but it includes tax, which is an operating cost. When we use net profit, sometimes this tends to understate the return as the after-tax cost of finance has not been removed. So how do you decide how to calculate your return on assets? I would be guided by the question. If you have to compare your ratios and your analysis to an industry analysis or to another company, then it is imperative that you look at the way they have calculated their return on assets. And then it would make sense to calculate yours in a similar manner. However, you must also be guided by the objectives of the analysis. So if we want to assess the return on shareholders' funds, we can calculate our return on equity ratio. So this is calculated by taking your net profit attributable to ordinary shareholders' equity, which means you'll have to minus any preference dividends, if you have any, divided by our total ordinary shareholders' equity. So remember when you looked at risk and return in one of the prior weeks, you would have looked at operating leverage. So operating leverage also gives an indication of a company's profitability. So if we think back to that week and what you covered, you should have learned that you can calculate a degree of operating leverage. And if you are assessing profitability of a company, this ratio can be relevant. Remember, it was calculated by taking your contribution divided by your earnings before interest and tax. If you do not recall this, please go back to the week where you covered risk and return and revise this. Our break-even and margin of safety ratios also give an indication of profitability, so this can also be included in your analysis. So how do we calculate our break-even units? You should remember that this can be calculated by taking your fixed costs divided by your contribution per unit. And the break-even units reflects the volume of sales units, where your sales revenue will equal your total costs. Then if we look at our margin of safety, remember your margin of safety is calculated by taking your expected sales minus your break-even sales divided by your expected sales. This shows by how much sales can decrease before a loss is incurred. The last group of ratios we are going to look at are market value ratios. The market value ratios will indicate what investors think of the company. Therefore, it will reflect the relationship of the entity's dividends and earnings to its share price. If we look at our dividend yield ratio, this is calculated by taking our dividend per share divided by the market price per share. The dividend yield ratio indicates the return that investors are obtaining on their investment in the form of dividends. In the long term, shareholders would earn both dividends and capital appreciation on their shares, so the total return would be considerably higher than the dividend yield ratio. The earnings yield ratio is calculated by taking our earnings per share divided by the market price per share. This ratio indicates the yield investors are demanding. Now, if we look at our next ratio, which is our price earnings ratio, you'll see that the price earnings ratio is the inverse of the earnings yield ratio. So our price earnings ratio is calculated by taking our market price per share divided by our earnings per share. The P/E ratio shows how much investors are willing to pay per rand of reported profits. Then if we look at our last market ratio, which is our dividend cover ratio, this can be calculated by taking our earnings and dividing that by our dividend, which can be per share or in total. Our dividend cover ratio measures the extent of earnings that are being paid out in the form of dividends. Now that we have covered how to calculate the various ratios, we actually need to learn how should we be analyzing these ratios. Remember we said that the calculation or the performing of the ratios is actually not the analysis. When we calculate the ratios provide the tools of the analysis, but it is not the actual analysis. Once we have calculated the ratios, we can use those ratios to perform the analysis. Remember that when we perform financial statement analysis, each ratio or group of ratios is almost like a piece of a puzzle. And when we have all of the ratios together and we can analyze all of the ratios together, we are basically making a puzzle. And once we have calculated all of the ratios and we have analyzed all of the ratios, we are left with a picture of a company. So now that we have learned how to calculate the various ratios, we are going to focus on the analysis part. So when we analyze something, it means more than stating what we have calculated. 3 steps which will lead to a good analysis. The first thing we need to do is we need to say what has happened. So here we will look at the ratios and we will see how they have moved and compare them year to year. Or if we are comparing our company to another company, we will compare our ratios to their ratios. Then we are going to suggest reasons why the ratio has moved. Here we will need to dig into the ratio and see what the ratio is made up of, and we will want to assess why has our ratio moved. The scenario could also give you an indication as to what is happening in the background, and this could also give reasons why the ratio has moved. The last step is to give likely implications. Here we will assess the likely implications for the company and what the analysis of our ratios could mean for the company going forward. In the past, many of you could have done a surface analysis, but at this level, it is required that you do a deeper, more meaningful analysis. So by using these 3 steps, it will enable you to perform a deeper analysis, which is the analysis we are looking for. So after looking at the model of how to perform a good analysis, we saw that it was made up of 3 steps. So now we can go through an example of how to perform an analysis and compare different answers. So in our example here, we are told that we have an operating profit margin of 13.8% in 2014 and 10.6% in 2015. We are also told that the interest cover is 1.94 in 2014 and it is 1.46 in 2015. So what should your analysis look like? Here we are going to compare a poor answer and compare that to a better answer, and then we are going to compare that to the best answer just to show you how we want you to answer these questions and in what detail we want you to perform the analysis. So if we say X's profit margin has fallen from 13.8% to 10.6%, then this is a poor answer if we leave our answer at that, because we are simply saying what has happened, but we have not given the implications of this or explained why it has happened. So if we say X's profit margin has fallen from 13.8% to 10.6% and we leave our answer at that, it is not a full answer. It is not painting a picture of what is happening in the company. We are simply saying what has happened. We are saying that the profit margin has fallen, but we are not giving likely implications or explaining why the profit margin has fallen. So it is a poor answer. If we answer that the interest cover has fallen from 1.94 to 1.46 and we leave it at that, again, we are saying what has happened, but we are not saying why it has happened or giving likely implications. So it would be better to say that X's profit margin has fallen from 13.8% to 10.6%. because it may have had to reduce its selling price to maintain market share in the recession. So here the answer is better because we are saying what has happened and we are saying why it has happened. But here again, you can see that we are not giving the implications of the profit margin falling. So it is a better answer, but it is not the best answer. If we say that the interest cover has fallen from 1.94 to 1.46 because profit has declined, so even though interest levels are constant, there is less income available to service the debts. So here again, we are saying what has happened and we are saying why it has happened, but we are not giving likely implications of the interest cover falling. So it is not the best answer. If we go to the next slide, we can see the kind of answer we want you to give in a test or exam or even in your tutorial questions. So the best answer would be to say X's profit margin has fallen from 13.8% to 10.6% because it may have had to reduce its selling price to maintain market share in the recession. So here we have said what has happened and we have said why it is likely to have happened. But then we go on and we say what the likely implications of this could be in the future. So this might lead to a price war in the industry and it could cause X long-term problems. So as you can see from this answer, this is a full answer. If we use the steps in the model, it will lead to a deep analysis, which will ensure you get maximum marks and you get the full picture of the company. So if we look at the interest cover ratio, we can see that the interest cover has fallen from 1.94 to 1.46 because profit has declined. So even though interest levels are constant, there is less income available to service the debt. So this has said what has happened and it has suggests reasons why. But now we go further in the best answer and we give likely implications of the interest cover ratio falling. So the ratio is still greater than 1, meaning that the company X should not have any problems servicing the debt in the short term. But if the trend continues, it may lead to a downgrading of the company's credit rating, which will make it harder for X to raise finance in the future. So as you can see from the best answers here, we have discussed what has happened, we have suggested reasons why, and we have given likely implications. So if you compare the best answer to the poor answer, you can see that when we look at the best answer, you get a deeper analysis and a fuller answer. And this is likely to score you the most amount of marks. So far, we have examined a number of important ratios and analyzed them by comparing them to both ratios from previous years and industry averages. So we can combine these ratios to obtain an overall picture of the company. This is referred to as a structured analysis. So the first structured analysis we are going to look at is the DuPont analysis. So as the objective of financial management is to maximize shareholder wealth, a structured analysis aims towards measuring how effectively this objective is achieved. So the DuPont model uses the return on equity as an overall indicator of success. So if we use the DuPont analysis, it helps us to identify reasons why the overall success indicator, return on equity, is higher or lower than expected. As you can see from the formula, it structures the return on equity into its main components: income, investment, and capital structure. Here you can see that the net profit margin is multiplied by the asset turnover, which is then multiplied by leverage. So if we look at the net profit margin, here we have sales, and this will cancel with the sales from the asset turnover. So we will be left with net profit over assets, which is actually the return on assets ratio, multiplied by assets over equity, which is known as the financial leverage multiplier. Then if we cross out the assets in the return on assets ratio by the assets in the financial leverage multiplier, this will leave us with return on equity. Please have a look at figure 5.2 in your textbook for more information on the DuPont analysis. What is the point of failure prediction models? So although ratio analysis provides insight into a firm's operations, the interpretation is subjective rather than objective. So where does this subjectivity come from? It comes from the analyst performing the analysis. So if we calculate a company's ratios, we may see that the company may have a weakening of the current ratio, but could have improvement in its debt ratios. To what extent does the weakening of the liquidity ratios net off with the improvement in the debt ratios? So it is very difficult to assess whether a company will succeed or fail by looking at all of its ratios because there is subjectivity involved. So as a result, analysts require more objective assessment. So predictive models based on ratios have been developed, and the one we are going to look at is known as the Altman Z-score. So in this slide, we are going to look at failure prediction models. So far, we have looked at the various ratios when we did ratio analysis. And when we analyze the ratios, it can provide insight into a firm's operations. So if we want to assess whether a company is going to fail or if it is going to succeed, it may be very difficult to tell this by looking at the various ratios. We could have a company that has weakening liquidity, but then it could have strengthening debt ratios. So how are we going to assess whether a company is likely to fail or succeed? And the best way we can do this is through an objective failure prediction model. The ratios we calculated previously are subject to subjectivity, and this comes from the analyst performing the analysis. So if we use an objective failure prediction model, it will result in a more objective assessment. So there are various failure prediction models, and these allow a statistical analysis. One of the best known models is the Altman Z-score. You can see the Altman Z-score formula in Formula 5.1 here, and it is also in your textbook. So if we look at the formula, we can insert working capital over total assets for X1, and X2 we will insert with our retained earnings over total assets ratio for For x3, we'll insert EBIT over total assets. For x4, we'll insert market value of assets over book value of total liabilities. Once we insert all of the figures for the company into this formula, it will give us a number known as the Z-score. So if our Z-score is greater than 1.81, then the company is likely to succeed. If the model gives us a Z-score greater than 2.99, then it is said that the company is unlikely to fail, meaning it will succeed. If the Z-score is less than 1.81, then the company is likely to fail. There is a gray zone though if the Z-score has been calculated to fall between 1.81 and 2.99. So if the Z-score is in that gray zone, then we cannot really determine with accuracy whether the company will fail or succeed. So since this model has been developed, there have been adaptations to this model. Altman has updated and improved this original model with a new Zeta model. So it has been claimed that the new model can predict financial distress with a greater degree of accuracy. So the updated model is in your textbook if you want to have a look at it. There have also been similar models developed in South Africa. One by Dr. J.H. Delaray has been developed, and the formula for this is also in your textbook. Right, students, now that we have gone through how to perform a ratio analysis and gone through the various types of analysis, we can now discuss the limitations of ratio analysis. The first limitation is that some firms are diversified into multiple industries. So this makes it difficult to compare firms against one set of industry averages. So companies should rather perform segment reporting and then compare each segment to the industry. Another limitation would be that management strives to be industry leaders, not just average in the industry. So if we look at the second limitation, we'll see that management strive often to be industry leaders, and they don't just want to be average in the industry. So in many instances, they would compare their results with the leading companies, which would make their ratios look very bad. If we have a person who owns a grocery shop, and he is comparing his results to Spar and Checkers or Pick n Pay, which are industry leaders, then it would automatically make his ratios maybe seem not as good. Another limitation would be the effect of different companies having different accounting policies. So this makes inter-firm comparison more difficult. So think here of your depreciation policy. Two companies could have the same asset but could treat it in a different way. This would have an impact on your asset balances and your depreciation. When performing ratio analysis, companies who have different year ends could result in ratios that are not comparable. So when doing a comparative analysis, the timing of year ends should be considered for both of the firms being compared. It is also possible for a firm to window dress its financial statements, thus reflecting an improved financial position. Another limitation is that it is difficult to assess how good or how bad a ratio is. It is open to interpretation, and this depends on the situation of the company. There is also subjectivity involved when performing an analysis. This subjectivity can be due to the perception of the analyst. Some ratios might indicate strong points, while other ratios may indicate weak points, and it is difficult to assess to what extent the strong points offset the weak points. Another limitation that we'll find is that as financial statements are based on historic depreciated cost, this means that they are not adjusted for inflation. So often the accounting amounts are removed from economic value, and this will have an impact on our ratios and our analysis. So over time, this makes ratio comparison less reliable. The last limitation is that the past is not necessarily always an indicator of the future. So you can perform an analysis and the company could have done extremely well for the last 10 or 20 years, but this doesn't mean that what happened in the past will definitely happen in the future. There's always risk of a recession or some kind of market failure or market crash. So those are the limitations of ratio analysis. If we go to the last slide, you'll see that we have come to the end of our lecture on financial statement analysis. If you want more information or more videos to watch, I highly recommend that you watch these two videos here.